Good morning. Tuesday, April 15th. I'm Zach Howard. Here's your morning market update. Thoughts I'm looking at today. So who owns all the US debt? There's 36 trillion plus in US debt, but bigger picture is who owns it out there. The rest of the world outside the US, Japan and China, the biggest treasury holdings. So over the last week, a lot of conversations about those nations potentially dumping US Treasuries. But maybe that's not the question. Maybe the question is, what about if they just don't show up in the upcoming Treasury auctions in 2025? What does that do for the price of bonds, the price of risk? Who is the marginal buyer? Those big buyers for the last 15, 20 years are not there. Is it the US pension system? Is it mandated by Congress that XYZ funds need to hold X percentage of US debt? We'll see. We'll see what happens. But this is a breakdown currently. 33% own foreigners own US debt. The R word, the famous Doom at 11 crowd on FinTwit, on YouTube, using that recessionary word. I think you're missing the bigger picture. Forget recession. Guess the headlines and all that. What is a recession? More importantly, it's the rate of change, the slowing of revenue and earnings to companies. That's really what you should be asking is, and what is the legitimate price of assets based on forward cash flows if we have a slowing global growth, global earnings? Historically, we can look at the S&P 500. If we have PE, price to earnings multiples of 18, we're potentially trades at going forward. What about the earnings though? Like it's easy to price in with a forecast price to earnings, but if the earnings multiple, the denominator is wrong, well, the price is also wrong. So I don't think it's as important to determine where the recessionary forecast is, but more importantly, where's the expectations for growth? Where's the expectations for these companies? If they have slowing cash flows because rate of change, the peak of their earnings is in for the short term of the cycle, they're going to have to cut costs, which leads to job cuts. The other question is, does a stock market decline cause a recession, or does a recession cause a stock market decline? In the United States, the amount of wealth, fiat wealth that's tied up in US equities and thus the stock market is at a historical all-time high. So when you have this drastic of a change in people's perception of wealth, what they see in their 401ks, their online trading accounts, their perception of how good they're doing is artificially, negatively, or positively skewed. That's what we're looking at here. We had this drastic rate of change decline. It's the violence of the move more than the absolute of the move that stops or breaks markets. That's what volatility is. That's what we're seeing here. Back to sentiment. Consumer sentiment is rolling over. It is a pessimistic, negative outlook from where it's been just 3 months ago. That is going to show up in the reflection of how consumers spend their money, whether it is that in discretionary items or even consumer staple items. You're seeing this already in some of those stocks like consumer staples. The XLP ETF is outperforming versus the discretionary sector. Big drawdowns. Look at the math here. You're down 67%. You're down 40% on a position. You need 67% from there to get back to even. If you're down 50%, you need 100% of where the price of that asset, that trade is to get back to even. That is the takeaway. Avoid big drawdowns. Sizing matters more than entry level. Have a great day. I will see you tomorrow.